Super. Well, I would love to welcome our panelists to come join me on stage. Good afternoon. I hope everyone grabbed a cafecito after lunch. Let's all stay vertical for the next 40 minutes. It's a pleasure to kick off the afternoon session. Before we begin, I want to say thank you to Andres Lang and the entire Caricaco team. It's a pleasure to be here and to see and feel the magic of Caricaco Summit, and the amplification of last year to this year is amazing. During the next 40 minutes, we are going to take a journey and go back in time and talk about the history of the secondary market, then fast forward to the present and dream of the future together around the untapped opportunity of the secondary market. My name is Kate Kiewel. I'm on the founding team of Bicycle Capital, and it's a pleasure to guide the conversation today. To start, I'd like to welcome our panelists and let them introduce themselves and lay the context for the conversation to come. Let's start with you, Ben.
Hi, everybody. Ben Black from Akkadian Ventures. We're a just sub-billion dollar AUM multi-stage venture capital firm from San Francisco. We run 3 strategies. We have a fund of funds focused on AI, our flagship direct secondaries fund, which are on Fund 6, and a new pre-IPO fund that, talking about liquidity, we're actually going to take on the public on the NASDAQ to provide liquidity to our investors.
Thanks, Ben. Thanks, Kate. It's a pleasure. I'm Antonia Rojas. I'm Chilean originally. I live in Mexico since 5 years now. I'm the founder and managing partner of Attom Capital. We are the first direct secondary fund in LatAm. I've been investing in Latin America for the last 10 years in the primary space, and realized of this incredible opportunity that is secondaries. And Ben was a huge part of the reason why we set up Attom here in LatAm. So thank you again. And yeah, that's me. A pleasure.
Hi, everyone. I'm Raul Ramirez. I'm a managing director in the global corporate securities team at CarVal. CarVal is part of Alliance Bernstein's alternatives business, and we are a credit fund. So I'm going to be probably the fish out of water here. But we were actually founded. CarVal was founded in the late '80s during the SNL crisis. I know that most of you don't remember the 80s. You're too young to remember the 80s, and most of you were not even born there, but that's when we were born. If you think about the SNL crisis, it was like the prequel of the great financial crisis of '08 and '09, and we were created to buy loans from banks. That's what CarVal came from. And right now we have 3 strategies, mainly: asset-based finance, aircraft leases, and energy transition, or in energy. We typically invest in the secondary market, and we think of secondary market as different than my panelists here, but for us, it's like a $10 trillion market, and we mostly do that in asset-based finance, buying assets from banks or from non-bank financials, or buying leases, buying aircraft from leasing companies and then releasing them to second-tier airlines. We have invested over $150 billion during our lifetime, and we've been doing it again for like 30 years. So we're always going to be a speed dial for anyone that's looking to sell assets. It's people looking to sell assets. Sorry. Anyway.
Great. Thank you so much. So we have a diverse set of experts, investors that are equity investors, credit investors, with deep experience both in the US and in Latin America. Really starting really high level, flying the plane high, let's talk about the 2 ways that investors can access a company, either through primary or secondary. Most of the rest of the 30 minutes we're gonna spend on secondary, but at Bicycle Capital, we invest in both primary and secondary rounds. A primary round you enter, and it's oftentimes a continuation after the company has seen growth. So we invest, we agree on a valuation with the founder, and there's a primary round happening of new equity that's being distributed. In the secondary market, it's a little bit different, and we're lucky enough to have some experts here today to really dive deep in what is the secondary market. So starting there, would love to invite both Ben and Antonia to talk a little bit about the primary versus secondary and kind of the opportunity today.
So I want to refer back to the earlier panel where Eric referred to an exit, right? And he was like, I don't like the word exit, And then Yahal came up and called it a liquidation, which sounds even worse. Secondaries are the way we make your dreams come true, okay? Like, this is what I want you to think about, because at the end of the day, we're all in this together to create a flow of capital that has to keep moving, right? And this, by the way, I know we're going to talk mostly about companies, but fund secondaries are another thing to talk about, right? And so at the end of the day, in the US, starting in the 70s, there was a nascent market for people who bought other people out of venture capital. And it's incredibly important to an ecosystem because the money's got to flow. You can put money into an illiquid asset and everyone always only has a certain amount of time before you die. And it's really important to get the money back before you die. All right, and that's what we're here for at the end of the day.
I love the way that you said it. So maybe to just add to that is the fact that when you're partnering to a startup, you can do it in different ways, right? And as long as you're an investor that comes into the company to add value, the way professional secondary funds that focus on direct secondaries do, right? It's you're partnering to the startup just in a different way. You're entering the company by giving someone in the cap table money, right? So as Ben is saying, you're making someone's dream come true. But what's more important about all of that is that money usually recycles. So it goes back to the ecosystem and it's usually reinvested unless they are close to the retirement period instead, right? In that case, well, they can go buy a yacht or whatever they want to do, right? But oftentimes what has happened is that it recycles. And I think that we're going to cover a little bit about the history of secondaries in a bit, but I do believe it's very important to understand what is secondary. So we, instead of injecting money to the company, we provide it to someone, within the cap table, but then you're an active investor. So you many times exchange debt equity or equity that is no longer helping you in the cap table. Imagine a founder that left the company or an employee that had to leave the company, or thinking about an angel that was super crucial for the first 1, 2, 3 years, but then it's no longer their sweet spot to be helping, right? So it's important to do the transition. I always think about this sport game where the early stage investor passes the torch to the one that follows. And you start creating this middle layers of liquidity so the company can continue growing and you don't need to be artificially restricting the company to do an exit before it's ideal, for example, right? So that's the role that secondaries come to play in the ecosystem.
Thanks so much, Antonia. And before we really go to the history, there's actually a longer history than many of you imagine. I'd love to first tie it in to how it differs or how is it similar to the credit markets. Both Ben and Antonia focus a lot on the venture space as equity investors, but complementing the panel, would love to hear from Raul. Really kind of what is different, what is attractive specifically in the secondaries market for credit?
Yeah, thanks. Thanks, Kate. So, we typically will be buying assets from banks because banks, especially after the great financial crisis, changes in regulation, and also as they need to optimize their capital, they need to sell assets, and that's mainly what we do. We also buy a lot of assets from non-bank financials. Some companies like Antonia invests in, fintechs, for example, who need to basically sell assets to get cash and originate new loans, right? So again, it's to maintain the life cycle of their companies. And so we typically will be buying portfolios of, thousands of line items, short duration, so shorter, we don't lend money very long, and so we have good visibility and good downside protection. That's one part of our business. The other part, in aircraft leasing, basically what we do is we will be buying mid-life aircraft, which are 6 to 12-year aircraft from AirCap or the big leasing companies. Again, they also need to recycle their capital so that they can go and finance new builds. So we'll buy those planes from them, and then we'll release them to second-tier airlines. So it's, one of the things that Ben and I were talking about earlier is that, one of the advantages that we have, same in secondaries for them, is you have motivated sellers, right? There's nothing better than buying something from someone that has to sell. So that's really where we try and make excess returns.
Thanks so much, Raul. And as we've talked both on the equity and credit side, really secondaries should be seen as a solution. There's motivated buyers, there's motivated sellers, and I think now it's time to turn the time machine on and go back in time. And I'd love, Ben, just to lead just with your extensive experience and talk a little bit of how did the secondaries market get started? Where did it get started? How did it get started? I think that's a perfect place to start for the conversation today.
Well, Eric and Yahal gave us a really great history of venture capital, except for this one part of secondaries, right? So the first secondary that ever occurred was the 1974, where IBM had become a venture capitalist off its balance sheet, investing in new technology companies, and they had to exit, and that was the first real institutional kind of exit. And then it really didn't develop at all. And talk about time duration until 1991. When Paul Capital was founded. And Paul Capital was essentially the firm that started what we think is a modern secondary fund. They were buying fund interests from venture capital funds. So we think about this, back then, you had 10-year funds, you could go public in 5 years. Now it's like, anybody raising a fund today, it's like 15 minutes. They're just lying to you. Somebody's like, I got a 10-year fund with 2, re-ups. Like, it's a lie. Like, they're 15, 17 years now. Yeah, and so secondaries, but think about this. So VC starts in the 70s. It's not until 1991 that LP interest fund start, okay? LP interest become a pretty big industry during the 2000s, the early aughts. But when I started and I was doing my first secondaries, direct secondaries, in 2010, there was no direct secondary market. The ability to go in and VCs hated it. CEOs and CFOs thought it was illegal to buy private company stock. And then it wasn't until 2011, I think maybe 12, when Facebook started to let employees sell, that the whole market exploded. So think about the time arc, okay? From 70s all the way to 2012, now it's a multi-billion-dollar market. And it is so important. And as I thought about this conference, and the one thing I would love this group to take away from is how important LP interest secondaries are in developing an ecosystem. And I want to tell you why it's such a great asset for institutional investors. If you have $1 of value in a net asset value in a fund, typically when you're going to sell it, you're going to usually sell it at 65 cents on a dollar. That's kind of the average price right now. You as the buyer get to immediately, under GAAP accounting rules, you get to mark that to $1 the second you buy it. This is why pensions in the US love it. So I know there are smart people out here from some institutions who have the ability to start buying fund interests and immediately getting that markup. And I think that that's where secondary interest, Attom Capital is like a pioneer of direct secondaries. Amazing that you're already doing it. And you need that too, clearly, and she's doing a great job. But somebody should be doing fund interests. And I know that there's a little bit down here, but there should be a local, institutional base that enables that velocity of capital to keep the capital keep moving at the fund level. It's really important if you're going to develop an ecosystem.
Yeah, I wish we would have it soon, because many of us are LPs.
It's such a great opportunity.
Yeah, in many other VC funds, right? So the sooner that you get your money back, the sooner that you will invest in other VCs, in other funds, in other startups, etc. I think that one of the things that Latin America experienced before the US, in that sense, is that since a lot of the capital that reached the region in 2021 and 2022 was from the US, there were many secondaries in those transactions, right? So I guess that's something that the US didn't experience because you guys were the first ones, right? So when we launched Attom, we are the first direct secondary fund in LatAm, right? So doing it locally, doing it through the relationship with the founders, and we have been extremely focused on being one VC more in the cap tables, right? So we're not just transactional players that just wanna, make the J curve not a J curve, right? But I think we do have to realize that there is a part of the job that was already done by the US in the secondary transactions where historically, we've seen way more secondaries in fintech. So that's one of the reasons why we've been more focused on the fintech space, because usually there is more transactionality and more liquidity. Not sure why. Maybe there is like more sophistication or more ability to open up to the fact that you can transact the shares. So not really know what's the cause of the fact that fintech has more transactionality in LatAm as opposed to other regions. I mean, other sectors. But I do appreciate the fact that we started seeing secondaries through that. But we need local players, and LP stakes would definitely accelerate everything, right? Because like I remember when we launched, so many funds were like reaching us and like saying like, "You're our savior," and I'm like, "No, I'm small, still, I will do 12 companies and that's it," right? So we definitely need that money to rotate, and that created an inflection point. And I think one last point to mention is that in every single market that a secondary fund was created, and the US, Europe, Israel, Australia, very recently, the first secondary fund in Australia was started 4 years ago. And talking to the managing partner, he said, like, the most beautiful thing about launching the fund is that most of that capital went back to the ecosystem, right? So that's what happens. It's like, it's an inflection point in the development of that ecosystem, because like that money recycles back. You can fund way more entrepreneurs solving the hardest problems of our region, right? So I think like we need to like try to solve it in so many different ways, but any way is a progress, right?
Tying that all together, one thing I really want to pull on this thread of the US market kind of was the initial secondaries market with a lot of concentration and origination from LP interests. Would love to compare of, today versus Latin America, just thinking about the LPs and the LP types, curious, the secondary opportunities, specifically mainly in companies, just curious, to pull on the thread of why did LP interests start? Do you have some examples in the US? And then how does that translate to how we think about really the emerging secondary market that's a lot more recent here in the region?
I think that the LP interest markets started because of the dynamics of those transactions, the inherent profitability of each transaction. And that once, firms like, and this is incredible to think about, like firms like Lexington, for one, like these firms started back then and they've just become huge. And it's so important for like the endowments and the pensions in the US to be able to recycle that capital, exactly like you said. So I'll give you an example, very specific. We just had an LP who needed to sell their stake in their 2012 vintage fund, and their stake was a 2014 vintage. It's a fund of funds. They had 25 bidders on that fund stake. 25. That's how alive that market is for an end-of-life fund. Now, of course, like that sort of cleans it all up and everyone gets to start again. That's how active the market is in the US.
So I think that something that's quite interesting about secondaries is that you can kind of like play a bit with the times, right? So when talking to someone within top tier capital, for example, that they do LP stakes, and what they do is like they start buying at the end of the funds, right? So you get what Ben is saying is that you're buying, with this discount and you immediately do the markup. But the other beautiful thing is like you're at the end of the cycle of liquidity of a fund. So you start investing and probably 2 to 3 years afterwards, you start receiving money back, because the fund starts doing the distributions. Distributions in funds start in year 8, right? Not before that. So, and like 9 and 10 and even 11 and 12 are the ones that like highest liquidity comes, right? So it's a very good way to manage your portfolio and to manage the timings of distributions, right? So if you're an institutional player and you want to do allocations properly, you can time those different asset classes in a way that you have VC, 10 years, 12 years, even 15 years, but then you include secondaries in these different layers, and you can start having this like cycle, like recycling, and almost like becoming like an evergreen within that strategy, right? So it's quite dynamic.
Very interesting, and kind of complementing on what Ben and Antonia shared, In the credit markets, what dynamics are similar? What are different? Do you find kind of the LP profile has impacted in any way the growth of the secondary market?
Great, thanks. So I think that the key in credit is having the right type of capital, similar to what Antonia and Ben were talking about, right? It's like, if you have short-term capital, then you always run the risk of being the motivated seller. It's not the position you want to be. That's where you sell at 65 cents on the dollar, right? So we need, that's the key for us is we have, 7-8 year money, which again, compared to this guys, it's not too long, but our assets tend to be, 2-3 years. So we can take those types of risks because we have the right type of capital, whereas a lot of our competitors or people that have to sell don't have that flexibility.
And within the credit market, you mentioned banks playing a really unique role. In terms of firms, are there any specific secondary focus firms, or who would you say are the main players or most people are engaging in secondaries?
Yeah, so I mean, it's going to be mostly credit funds like ourselves that are going to be buying assets. And we think of it like, we're financing them, but we're really taking over control of the assets and making sure that we understand them fully, right? Again, like I said, the airlines, right? Aircraft. We did a deal for a Canadian airline where we bought 8 737-800s and we leased them to them. We own one of the 20 largest leasing companies in the world. And so we get to see all types of assets and we can choose the best ones we want. For example, in this case, it's not just buying planes, but it's like what type of plane you buy. So we're buying 737-800s, which are planes that have been around for a long time. You're not taking technology risk. Any problems these planes had were fixed 15 years ago, right? So you're not taking 737 MAXs. So I think, the firms that are successful, I think we are, knock on wood, we look at, even though we're lenders, we're credit guys, we think of the assets as if we were the owners.
And transitioning a bit to just talk about, we've talked about the past, we've laid the groundwork of, what has come to fruition today. But what does the secondary market look like today? I mean, I see a lot of hype deals, a lot of secondary transactions. I'm in a lot of group chats that are surprising. Be curious, both from the US perspective and then talking about LatAm, kind of what are we seeing right now in the market?
Well, in the US, the secondary market compared to primary venture capital has always been and will continue to be the Wild West. There are two worlds right now in venture. There is the super hot AI companies where, everyone is trying to just bid on these assets that are very, very hard to buy. There's a lot of bad actors, a lot of people just with no information. There's many exchanges. Just ourselves, we work with 67 different brokers. It is an incredibly dynamic space. And then outside of those AI companies, the open AIs and the Anthropics, the ones you guys heard on, then it's like crickets. It's like you could have a $200 million software company that's profitable and no one is bidding on it. And it's just unbelievable, the bifurcation. The other issue is one of information. There's when we buy, we work with the company, we partner with them to provide liquidity to their shareholders. Just like a primary investor, we need information. We have a fund. But I would say 80% of the market is literally buying blind. How bonkers is that? They're just going on people and just be like, there's some common stock, it's for sale. I can put $100,000 down and I can try to snap it up. It's crazy. And then a lot of people, some people make money and they talk about it, and other people lose all their money and they don't talk about it. So that's kind of the way the market is in the US right now.
Yeah, I think that in Latin America, we have the opportunity to learn from what's going on in the US. Because as Ben is saying, this is a market that is quite tricky. There is a market that there is a lot of adverse selection on one end. There is a lot of lying as well. So you really need people doing secondaries that know the ecosystem and like that can build trust with the founders, right? I think like the worst nightmare of a founder is like not having control over what's going on in your cap table. And that's what's happening in the US right now, right? So founders no longer know who are their partners, who are the people that are having shares of their company. And I see all this belief of like creating this liquidity for the private market. But there is a reason why that company has decided to stay private. And that's something that we need to respect, you know, because like the founding team is deciding at one point and at what point they want to be public. And that's a whole different set of rules for a public company, right? So I think that in Latin America, we do have this opportunity to kind of like reflect and think and like be really conscious on where do we want to head? Because it's extremely important that we allow the founders to choose where they want their company to go, right? So we've been trying to kind of like talk a lot about what secondary is, you know, what is our mission within Attom, and like we would welcome any other player that wants to like work with us on this, because like I do think that we have this incredible responsibility of driving and building this great opportunity, but like building it responsibly, right? So we can build it in a way that it's useful for the founders and for our society, because at the end, founders are the ones building and solving the hardest problems of LatAm, right? So I think that's kind of like what we are in the stage of doing it.
Just to build on what you said, like I would say that private capital markets were not designed, capital structures were not designed to have $300 billion companies, okay? Like, think how fast OpenAI went to 300 billion, okay? The IPO market is broken. Let's all talk about that. Like, why is it broken? Because it's been eaten up by the private markets. Because for the best companies, it is now better to be private than it is to be a public company. I mean, think about that. When Databricks can go to $15 billion primary, secondary offering, when SpaceX can literally do $1 billion every 6 months in liquidity, what is the point of the public markets? Because they can get all that with no responsibility for transparency, no accountability, no short selling, no Sarbanes-Oxley, none of that. It is a fantastic thing to be the CEO of one of these companies. Like, unbelievable, right? At the same time, the public is totally gypped. It's created this insane system of like even more Wild West, where you've got entities that get allocations, that don't have funds, that control the allocations to these companies, that create special purpose vehicles, and then there's second level special purpose vehicles within that, and the companies have completely lost control of their cap tables. So, I mean, it's pretty wild, actually, when you think about it. And that's new. Like, that didn't exist 5 years ago, but here's where we are.
Yeah, just so we don't end in the wrong, like in the negative tone. I will switch a little bit.
You can avoid all that. You can avoid all that.
Yes, exactly. We can avoid all that, but let me tell you kind of like something that you can do with secondaries that before it wasn't possible in Attom, right? So I think one of the biggest issues that many of the entrepreneurs that were in the early days, you know, is that they have this like highly concentrated portfolio, cap tables, right? So they got very diluted, right? With secondaries, you can do whatever you want with the cap table as long as someone is willing to sell. But fortunately, or, you know, as my colleague here was saying, there are these motivated sellers, you know, that are usually those more legacy funds, or, well, there are legacy funds that are amazing, like all the ones that are here, but there are others that are no longer working anymore, you know, but they are owning 40 or 50% of a company, right? So you can buy them at a very good discount. And then, you know, the secondary fund doesn't need to skip all the equity, but they can give some back because they bought it at a very good discount. They can give it back at a stock option for the company, right? So, you know, sky is the limit on how many things you can do with secondaries. So there is like things that we need to be paying attention not to fall into, but then there are all these other things that we can solve the cap table of many companies that were uninvestable. Sorry if any founder has that company right now. They were uninvestable, right? But now they can be solved. So that's kind of like one of the things that really excites us at Attom, right? That we can be fixing those problems when we see a good company and a founder that is willing to work with us on that, and we can make an uninvestable company an amazingly investable company, right? So there is, if we do things right, I think we can quickly see the amazing positive things of this ecosystem.
And for LatAm, I think it's opportune timing that the ripeness of the ecosystem, we're seeing funds themselves on Fund 3, Fund 4, and we've seen that trickle of capital really grow some amazing companies. And no one can deny that on the macro level globally, like the IPO window and going public, the dynamics are not the same. And so we do have this huge opportunity, and the activity I've seen in Latin America today has all been quality, thoughtful. There's been a lot of trust between the exchange of secondaries. At Bicycle Capital, we don't brand ourselves as a secondary fund. However, we look at all opportunities. Our second investment was a secondary transaction. And for us, we knew the founding team, we knew the fund that was looking to sell, that was very strategic for them and their own models of when liquidity made the most sense for them and their risk profile. And so for us, I think the secondary market is just another way to enter the cap table. And I think to date, I've seen great behaviors. There's been a lot more data transparency. And it's allowed us, again, to come in, help an existing investor that's ready to sell. We know the founder. We have a long-standing relationship. And we came in at a pretty big discount to a primary round that was soon to happen. And so for us, it's kind of the best of all worlds. And it works really well when we have ecosystems that everyone knows each other. There's a lot of trust. There's a lot of transparency, and really the stage of the ecosystem, which LatAm is growing and developing. However, many of us have seen each other for the last 8 years at, multiple times a year. So it's like a family reunion. So from that perspective, I think the future is bright and the foundation is strong.
I just want to add to that the pioneers in the secondary market do incredibly well. I've seen the early returns from the pioneers from Israel, the first secondary fund from Poland, the first secondary fund from Estonia, one of the earliest secondary funds from the UK. The people who start their markets do incredibly well. So your pioneers here, I think, are incredibly well positioned as this market develops. It really is a very truism that the pioneers, the returns are amazing. Like our first fund, when I was a pioneer, it was extraordinary, 6.5x, like it was amazing. And no fund has come close. Now I'm just grinding it out with everybody else.
Yeah, what can I say? I'm happy being the pioneer.
Well, I love Ben's perspective. It feels like he's been a cowboy leading the charge and is not afraid of the dynamics. But what mistakes do you think we can avoid? Or what are things in the ecosystems, whether it's founders, LPs, funds, like what are things we can do to build in kind of this great foundation that allows the market to move swiftly but thoughtfully in LatAm?
Well, I think that the secondary market is full of sharky people. I think that Antonia is especially if you get American secondary funds coming down here. Like there are some that are another breed. There's a lot of bad behavior when you're dealing with institutional secondary funds that are dealing with trying to purchase out individuals, where there's a real asymmetry of information. The companies that have problems are the ones that stick their head in the ground, and they just don't decide how they're going to handle it. And at the end of the day, you're going to come to a point, and there's so many entrepreneurs here, where your company is successful enough, and somebody's going to come to you and say, hey, I got a problem. Like, I am a fund, I'm on year 10, or I want to, I need a house. Like, so much of our money goes into San Francisco real estate. And then you're going to have to decide, what do I do? And you have to treat your secondary partners as carefully and vet them as carefully as your primary partners. But the absolute mistake is to sit there and go, that's between you and them. You guys deal with it. We're not going to cooperate. That's going to create a whole bunch of bad information. Come up with a policy, get organized, and look for secondary partners just like you would look for primary investors.
So within Latin America, I mean, we're very early. Of course, Antonia, you're leading the charge, but right now, where would someone find a secondary opportunity? You know, how is it coming about today?
I think that if you're a new player in the ecosystem and you're entering into you're entering the ecosystem through secondaries, ouch. You know, I think that it's in order to get access to the best companies and to get access to the information, which is what Ben is mentioning, which is the hard part, you need to have the trust of the founders first, right? Otherwise, you're like acting blindly. And there is, again, as I was saying before, there's a lot of adverse selection in this space. If someone wants to sell you a company, you need to wonder why. You know, you need to understand why they want to get out. Sometimes it's quite obvious. It's like, yeah, I'm in year 10, you know, and like I just need to start giving money back to my LPs or they are not going to allow me to do an extension, for example, you know. But sometimes it's less obvious. Like it's an early stage fund that is in year 3 or 4, and then they want to start fundraising for their next fund. Therefore, they need some DPI, right? So you have a valid reason, but then you need to find the valid company within that portfolio. So it's best to be done by someone that is within the ecosystem, that knows the opportunity. And then you have, you know, with existing VCs that they are the ones like calling their other colleagues that they like working with, like, hey, let's do this together, right? So in Latin America, everything is done through relationships. Like secondaries is exactly the same thing, and I would say it's even more, right? Because it's like you can be moving out blindly if you don't trust those relationships.
And Raul, thinking about the credit markets, thinking about the US market, I know that you touch emerging markets as well. You know, what have you seen as really conducive to building kind of this trust in different transactions? And is there anything that you would recommend as the LatAm market is starting to grow, just to be intentional about?
Yeah, I think Antonia touched on a very important point, which is why are you seeing the opportunity? And I think, you know, we're very skeptical. And my first question always is, why am I so lucky, right? Why are you selling me this, right? And so I think if you don't understand why someone is selling, you probably should stay away. And I tell people, like, you know, for example, we financed a company in Mexico that does payroll loans because their main source of funding went out of business. So all the banks are going out of that market, and we're the guys rushing in. We're the idiots running into the burning building, right? So you need to do that a little bit if you want to be successful in secondaries.
Maybe I will just mention one other thing. At the end, this is a long-term game, right? So you can have different horizons for a specific investment, but like the ecosystem is quite small, right? The people that have been investing for 10 years, like we all know each other. The ones that have been for 15 years know each other, and we keep bumping up with each other, right? So at the end of the day, you always need to think about a transaction that it needs to feel like a win-win. It needs to hurt a little bit for both, you know? So they are both like feeling like, okay, I won, you know? It's like you want that person to call you again and say, hey, by the way, I now have this company. So that goes both ways. One, you cannot be the shark one that says like, oh, since you're very distressed, you know, I'm gonna take advantage of you. And then that person never wants to do business with you again, right? And then if someone sold you a bad company, you don't wanna do ever business with them again. So you always need to think that this is a long-term game. You're gonna find and you're gonna see that person always, you know, unless you don't like tech, which, I mean, yeah, we're glad that you're gonna leave, you know.
Amazing. Well, I mean, today we talked about everything from the equity markets, the credit markets, US, LatAm. I think the foundation is strong and there's a lot of inertia forward. Trust is very important, and the truth is secondaries aren't going away. And as there's more activity in the ecosystem, there's only more opportunity and activity for the secondary market to be activated. So without a doubt, you know, as the current window of the IPO market and macro, you know, secondaries are this solution, and it's something that, when done right, everyone is happy. And so trust your gut, You should always ask yourself, and do you understand the transaction? Why would someone be selling? But go back to your gut. Your intuition never lies. So thank you so much to our amazing panelists that really walked us through the secondary market today.
You're the best, Kate.
Thank you.
Thank you. Let's give them a round of applause. Thank you, everyone.